first things first, I'd like to do a quick round of introductions. We kind of do lightning round. Tell us what you do, where you're from, and one really interesting thing that people may not necessarily know about you. And I'm going to start off with Adam.
Hey, there's a lot that's not known about me. I've been an early investor in a lot of companies. Unlike everybody else here who's a venture capitalist, we have a family office, so there's two parts of it. Yeah, there's two parts of it. There's the investment side, which is a fairly large fund, and then there's the philanthropy side. Somehow they connect. Early investors in Exalt with General Atlantic, and we maintain large LPs in Sequoia and NEA, and then some other smaller funds with kind of a different thesis.
Sure. And one interesting thing?
I like to rock climb.
Rock climbing.
Yeah, awesome.
All right, we're gonna dig in a little bit more later, but
Yeah.
Mike,
I got one here. Is this working? Michael Gilroy, early stage investor with Canaan Partners, $675 million fund. Write checks anywhere between $1 and $20 million. One fun fact about me is that I've built 2 homes and they were identical in shape and design.
Hi, I'm David Aronoff. I'm a partner at Flybridge. We're a seed and Series A stage investor here in New York and in Boston. And my background is actually in enterprise tech. For years before I became a VC, I worked at a couple of venture-backed startups that were enterprise sales focused, and so I come with a bunch of battle scars. Interesting fact, I race mountain bikes. And I started doing it 5 years ago, much against my wife's wishes.
Hi, I'm Hegazy. I'm an associate at Catalyst Investors. We're a growth equity firm here in New York, and we invest in tech-enabled services businesses. So we're writing checks anywhere from $10 million on the low end up to $60 million on the high end out of a $375 million fund. And I'm preparing for my second marathon, which is next week. So running in Pittsburgh, my hometown.
That's awesome. Speaking of that front, just as an aside, I decided to do something crazy and sign up for my own marathon. My first marathon will be in South Carolina in December, so I have a lot of time to slack off before I get really anxious about that. But let's kick things off. We're going to talk about B2B sales because I think there's a lot of mystery around it, particularly with startups. They're trying to figure out what the formula is. But just a level set. What do each of you have to say about the state of B2B sales today? Where are we at? What are you seeing out there? Because you talked obviously to a lot of startups, some that you do invest in, some that you don't. What are some of the basic top line things you're seeing? We'll start with Adam.
Yeah, well, I'm seeing a bit of a shift, and that's probably a good thing.
A shift how though?
A shift where, and Dave and I were just discussing this, where for the last few years we've seen a lot of vanity built in, particularly to B2B. A lot of that had to do with the entrepreneurs who were creating the companies, didn't really know how to get it into the market, so they were just kind of winging it and kind of hiring people without kind of a lot of structure. And they had a lot of direction, but they didn't have a lot of precision how to get it into the market, how to correctly compensate their sales reps, how to properly train them, how to communicate what the product is. A lot of companies built a product and they figured they would just get it onto the market and let the consumer decide exactly what the product is and then kind of align the price with that. I think now we're seeing a lot of a shift towards that, and hopefully it's going to continue, where people right now are the incumbents and now they've got to figure out what they have, and then they also have to build ancillary products that complement it and make them profitable.
Michael.
Yeah, it's certainly a very exciting time for B2B sales. I like to look at it as an investor from a kind of overall market size and growth perspective. And if you look at some of the estimates, the broader CRM bucket, which is what all of this will fall into, all of the tools that you all are using, is one of the largest in all of enterprise software, and it's also growing the fastest. And I think what that has done from an experience standpoint is created this mess of tools and data for all of you to look at every single day. And it has made the experience, particularly the top of funnel, because of all the strides we've seen with marketing automation, very, very challenging. And so I think we're at a point now where there's been a lot of strides there, and we need to kind of step back and bring everything together and create a holistic kind of sales experience for the rep.
Yeah, interesting.
So I guess for the past 5 or 6 years, we've really gone against what we've been investing in probably for the previous 15. And that is, even though we've been investing in enterprise tech, I think since the beginning of our firm and our predecessor firm, the big direct sale is kind of the first wedge, is something that we really frown against. And part of it is that there was this kind of hamster wheel, and the same thing kept on happening all the time. And that, I don't know if have any of you seen Mark Leslie's deck called The Sales Learning Curve? If you haven't, go Google it. Mark was the CEO of Veritas Software. He and his wife donated the Leslie Center down at NYU, and he's a professor at Stanford. He teaches about B2B sales and enterprise sales. And in this, he basically talks about this problem, this repetitive problem of hiring a big sales team too early in a startup's history, creating a business plan that relies upon that sales team generating revenue early on, and basically not just defraying the cost, but bringing essentially profitable sales, and it ends up being kind of a fallacy. And we backed this for generations and generations, and finally, I think we wisened up to the point where we said, no, you really have to get the product market fit right. So where we see kind of the state of B2B sales is really focused on, and since we invest in startups and at the seed stage, I think it's really relevant that the founders are the first salespeople, that they resist the temptation and maybe the advice of some investors to bring in the heavy-hitting sales team until they've really done enough sales to prove that the product market fit is right. And also have begun to find other ways into enterprises to start with either content-based marketing approaches, marketing directly to IT buyers or to the buyer within a company, and then once that's been proven, to bring in the sales team. Quite frankly, the sales guys like it better because they're able to make money sooner, and they're less likely to get fired as early as they might in the other genre. And so that's something where we almost exclusively invest now in our B2B startups.
And Mia, obviously you're dealing with a lot more of the later stage companies, so what's your perspective from what you're seeing at that stage?
Yeah, so I think to echo kind of some of the other comments, we're seeing a lot of capital going in toward building out the sales and marketing function, and there's a huge emphasis on culture at that point. And so you continue to add reps and you continue to add inside salespeople, and oftentimes there isn't enough focus on the efficacy of those reps. And so we're seeing now kind of this calling back, especially as the broader market is giving less emphasis on revenue growth and more focus on getting toward profitability. We're seeing a lot of our own portfolio companies and the portfolio companies of some other firms really just calling back their sales force, looking at kind of the bottom performing 10% on a quarterly or annual basis, and understanding that you can still drive culture, but you also have to drive productivity at the same time.
That's super interesting. Maybe we can just take a little bit of a tangent here, just about the culture and just the current environment around venture to begin with, because right now it seems like everyone's in agreement that there is a slowdown from the investor standpoint. That's really having an impact back into the businesses. So what are you actually seeing from some of your portfolio companies in terms of maybe that scale back, and how is that really playing into the sales teams? I mean, are they cutting sales teams? Are they cutting back? Are they trying to do something to bolster profitability? And last but not least, what does that mean for the client base that they've built up? Because obviously that's going to have a major impact. Anyone want to take it? We talk a lot about revenue quality, by the way, Adam.
Yeah, I mean, so the companies I typically I take a larger position and I come in individually, are typically larger companies. They're not a startup. Startups have their own problems. In startups, my difficulty is evaluating the people versus the company. So I like companies a lot more, and they've grown. Slack is a great example, and now they're going into enterprise. So the companies that I see daily are those companies now that are taking an inventory of what they have. So they've gotten a lot of top line, and the first conversation I usually have with them early on in our relationship is building in real-time analysis of what's profitable and what's not profitable, and then trying to calculate going forward what you can forecast. A lot of younger companies don't have reasonable expectations about what the attrition is going to be. And we've seen a behavior over the last few years where the incumbent really doesn't know if they're going to be the incumbent next year. So the companies that I'm seeing regularly are kind of the mid-sized companies at this point, let's say from 200 million to $1 billion valuation. And those companies now are taking inventory of what they have. I don't see them shedding salespeople, but for the first time ever, I see them now attaching real metrics to them. Before, the metrics were very fluid, and the metrics were more about getting looks, what I think of as looks, which is just getting a lot of whatever the category is, censuses or proposals out there. And so the measurement was just the pure quantity, and now I think the CEOs have kind of have recalibrated the culture, and it cascades down. So it's no longer the top. Now it's let's do an inventory of what we have and let's right price it, and let's build a culture that right prices it. And lastly, I would just say that requires a lot of discipline from the CEOs. So I'm also seeing for the first time, a lot of discipline in what is their client profile, and I'm seeing a lot more of them being rigid about what the pricing for the first time is really going to be.
Yeah, one thing I wanted to add to the points made by David and Mia before we switch topics. You talk about this idea of product market fit before you ramp the sales team, and our advice is actually hire the customer success rep before you hire the sales rep. Go out there and learn what is making your current customers successful before you go out and continue to sell this stuff, because what happens is you get to the next round and everyone's churning off, no one's upselling, and that ends up being a much bigger problem. So I would actually take it a step further and say, hire those guys first, really figure out what makes the customer happy, and then go out and hire the heavy hitters. In terms of the slowdown, it's absolutely something that we felt. We were just talking about a deal that we're doing right now, and the pre-money valuation is somewhere around half of what it would have been, I think, about 9 months ago. These cycles happen, and they continually happen every 6 to 8 years. I think what's different this time is that the supply on the VC side is much higher. You have a lot of people that just raise massive funds that have some kind of deployment cycle, and the money is going to come back into the system at some point. That being said, I think there's a disconnect between where we are in valuation and a lot of the entrepreneurs, and I think the bar is set higher, and we're seeing that in a big way.
So we've seen these cycles before, I think as Michael was talking about, and if you look kind of across the history of early stage venture capital, there's a split, if you think about a Series A investment without a seed, that of kind of right down the middle of 50-50, which if you did a survey of all the venture capital investments made over that time, probably resonate right around that. Depending upon whether it's a buyer of capital's market or a seller, it switches in favor of the investors or the entrepreneurs. And I'd say that what we've seen at the seed stage and the Series A is maybe slightly, and I'm talking about 5 to 10% in terms of that stage of investment, a move toward us. But most important, what we've seen is more time. So more time to look at seed investments where we would have had to make a decision in a week or 10 days, and we have a little bit more time to due diligence. Series A is a little bit longer. The impact on Series Bs, I think, is going to be more pronounced and interesting. But the best companies, even in tough markets, have always been able to raise at market prices. And so because we're only a seed and Series A investor, we are fully on the same side of the table as our portfolio companies and our founders when they go to raise a Series B. We want them to raise at whatever the fanciest price they can raise that round at. And we act as counselors and maybe therapists when it turns out that their expectations aren't met. But the reality is that doesn't designate how great a company you have. If you switch, I think, to the very later stage, that's where part of the problem is. And the problem is you've got a bunch of companies, and this is very different than, say, the 2000, 2001 timeframe, when you had a bunch of companies that had raised tons and tons of money at really, really high valuations. This isn't the first time we've seen unicorns. We saw the same level of valuations and even higher 15 or 16 years ago. The difference back then was that many of those businesses, maybe most of them, weren't real businesses. They had no fundamentals. They had been hiring just to hire. There was a refrain in the venture business which was hire ahead of the curve, which was just a huge mistake. Now we have companies that are real companies. They don't deserve the valuations they have. And so for the later stage investors that have to deal with markdowns, there's going to be a comeuppance, and we'll have to see exactly how that transpires. We've seen some debt rounds that help mask a down round, so you can avoid taking a markdown by raising debt. As Adam informs me, as long as you don't raise it in the public market. And we'll see some of that kind of those machinations for a little while. But I think that this is generally healthy, and I think that Michael would probably agree with me that as an early stage investor, this is an awesome time to be making investments, as 2008 and 2009 were.
Yeah. So, and just to level set, so I pulled together a panel to really represent the gamut of different stages of companies. So, Mia, if I'm correct, you're kind of that later stage, companies that have already raised several rounds of funding. David, your early stage, seed A. Michael, say C to Series C?
Yep.
Yeah. Adam?
Usually later stage.
A little bit later stage.
Yeah, 200, 300, up to $1 billion, and then after that, they really need some other competency and other money.
So from that perspective, what are the things that you're looking for now? What do you expect from the companies that you're evaluating for investments? Mia, maybe you can kick us off.
Sure. So we're typically investing in companies that have at least $10 million of run rate revenue. And that's not a hard and fast rule, but it really helps us understand the statistical significance of the customer base. So we like to take an approach of really evaluating their customer metrics and their unit economics. And $10 million has been a good kind of threshold for us to figure out whether they've figured out how to add customers on a profitable basis, not necessarily needing to be cash flow positive at the time that we invest. And so tracking metrics such as LTV to CAC, quota attainment on an aggregate basis, so just generally how much of quota is attained per quarter, and then also on an individual sales rep basis is really important, especially because at our stage, a lot of companies don't have a huge sales force, and you can kind of have the numbers be masked by some of the elephant hunters. So we want to understand just generally whether there's customer concentration, and then specifically how the sales force is performing.
So not too deeply embedded with a large percentage of revenue that's based on just a few customers, which certainly is problematic.
Exactly.
Maybe as we go forward, if we talk about like a metric, just like CAC, for example, is customer cost acquisition
cost.
So we'll actually dive in a little bit later at the actual metrics and stuff, but maybe come this way back around, just expectations around companies looking at what do you want them, where do you want them to be?
So if I avoid the seed where it's two founders and a dog in a basement somewhere, where it's really just a great idea, passionate founders who have some either relevant or proxy experience. If we look at when we're going to make an investment as it crosses over from a seed to an A, we've been doing this for probably a decade, and we've kept all the statistics, and so we have a sense of the growth and the proxies for customers if they haven't started charging during that period of time. And essentially, while we're not using it as a canonical number where we're saying, okay, here's an ordinal number and we're going to invest in companies above this line or below, we use it to inform the discussion, and we're looking for growth rates in terms of adoption, and we can talk about specifically what that means later, as kind of a proxy for customer uptake if they haven't yet been charging for their product or service.
Yeah, I mean, I think David covers it pretty well. Investing from seed through C, we actually, we see the seed stage companies where it's, two guys and a dog and or a cat in a basement and a pitch deck, all the way through C where you have, a sales team that's there, and we're looking for things like positive unit economics. At the A, the models are really important, and we need to build a case that we can get to positive unit economics at a B or a C, depending on where the company actually is in the life cycle. And it at the seed and A, it's also just a large part about data, usage, tickets, whatever it may be for that specific company. Again, just seeing growth and really knowing that customers love the product.
Yeah, so you guys see a lot more seed, so I'm not good at evaluating the C, so I really can't give any commentary to that. But what I can tell you is in the companies that I see a lot, I walk their floors, I can very quickly evaluate if they have the proper mechanisms to be able to increase pricing to their clients, because a lot of them have wrong priced their clients, and now there has to be a correction, or they have to fire clients because it creates problems going forward. So do they have the proper apparatus to bring on clients, to evaluate profitability, Do they have all the right apparatus, and do they have the assembly line required to bring clients through the entire life cycle?
Okay. So given that, at the seat, it may be hard to evaluate because you really based upon the entrepreneurs that are right there with the idea, not really much else, including metrics. But when you actually start to raise at the Series A, there is some data. And what do you see as kind of the reality versus the distortion that you see from the pitch decks and the data that's presented there versus what you actually see when you look at that early sales team or the sales team that's in place?
Yeah, so I think there are two that really stand out. The first is customer concentration. You see, we hit this 100K MRR, but if you really, look back at the customer data, 60K of that is one customer. And that's challenging for obvious reasons. The second one, which is related, is X customer has committed to increasing spend, X amount over the next year or so, and then you get on customer calls, and it turns out that every seat in the office is actually using the product, so there really isn't much upward mobility there. Beyond that, I think what you see in a pitch deck, it's always best to just lay it out as clearly as you possibly can. Whether it's in a footnote or voiceover, the answer is always gotten to in one way or another.
So maybe building on that, when you look at the early customers, we're looking for at least the emergence of a repeatable sale. And so trying to find out the texture of the sale, whether the first 20 of the customers happen to be close personal friends of the person running sales, whether if they weren't, how those customers were obtained. Was it kind of brute force, cold emailing? Was it really building relationships? Is there they burned through a massive funnel of leads in order to get 10 customers? I think that's part of it. We talk about the quality of the revenue, and the indicators, I think, become a large part of it. And then we look at the models, and we look at and try and understand things like, well, was a proof of concept, is that the end of it? Is it just a bunch of tire kickers? So with all due respect to any of the financial services giants who may be in the audience, there's a tell from a bunch of companies here in the city who POC everything. And so the idea of giving credit for one of those companies who shall remain nameless as part of quality revenue is something that we discount pretty dramatically.
Yeah, for us, I think it's the biggest divergence between the pitch deck and reality is really just the ramp time for the sales reps. So we see a lot of companies that assume that they're going to use our capital to really build their sales force, and that means just hiring 10 reps that will be effective on day 1 or day 90, and really it's not, most of the sales force isn't productive at all, and you end up turning it over. And so I think we spend a lot of time sensitizing models and really thinking about how many of those reps will be productive moving forward, and looking historically at how they've been able to ramp new reps as well has been helpful.
I think there's a lot of mysticism just in terms of expectation setting around building the sales team, particularly when you're scaling it out. That's one thing I see particularly daunting is the expectation of a rep being really productive off the get-go. Mm-hmm. It may work if you're talking about SDRs setting appointments, but what have you seen some egregious examples of founders coming in saying, yeah, we're going to just ramp up a 100-person sales team and we're going to take over the territory? That seems to be something which has happened recently.
It never works. It never works. I've seen that. There's definitely a strategy with having brute force. Brute force is a strategy when a product is extremely profitable and you're anticipating a recession. So you just want to flood the streets and get as much visibility as you can. And it's a cycle that, after that recession is curved a little bit back up, then you start focusing on the profitability, and you kind of have a tactic there of losing sales reps by attrition. But anytime I go into a company, I want to know how much they're charging. I want to make sure that they're charging as much as their competitors. If they've used a lot of technology, I want to find out that they're not giving the product away and kind of bidding against themselves. I want to make sure that sales reps are making a lot of money. I think of sales commissions as a form of profit distribution. Right. So I want to make sure that not only are they flooding the street with sales reps if they're using brute force, but that those sales reps, you're not going to lose your A reps, because your A reps are not getting properly compensated. They'll go someplace else. that they've properly compensated the B reps, and that they have some, discipline with, moving something with the C reps. So, I mean, from what I look at, the first thing I do when I go into a company is see how much square footage they have. I don't like companies that have a lot of square footage, period. Because usually they're, it's kind of like they're just, there's too much extra space. There's too many kitchens. There's just too many ping pong things. It's dangerous. It's a bad culture to have, because those type of companies, and there's one that, I've been very vocal about, a few actually, I've been very vocal about, they don't have a culture that can pivot in markets that I think we're seeing. So, a lot of people have asked me, how to now go from one part of the company where they were just burning venture capital money, and now their venture capital firms have there's a lot of pain, they no longer have that pain tolerance. So how do they shift to where the culture is now built on profitability and people are making money and the company can sustain? A lot of those companies that have employed brute force can't survive. They're really handicapped because they haven't built a culture that will allow them now to survive. From the ground up, they were built with a lot of waste. And when you start taking away all that waste, people go.
It seems like we haven't done smarter around B2B sales in some respect. It still seems to be more about brute force.
No,
have you seen something?
I think it's different. I mean, if I contrast our set of companies that are kind of in stride and in kind of sales mode today versus 7 or 8 years ago when we hit kind of the last real bump in the road, there's a marked difference. I don't see what Adam's seeing across our portfolio right now. And maybe we're just lucky, and maybe it's anomalistic. It could be that our selection criteria is better. But when I think about two of the portfolio companies that I'm on the board of, who are both kind of scaling, they haven't cut back. They cut the bottom 10% kind of regularly, but that has nothing to do with kind of the state of the economy. And both of them, started as seed stage companies that we backed, and they tested before they started scaling. So one of the companies went from, I won't give you the revenue number, but in 2014 was the first year of sales. They had, excluding the CEO of the company, they had 3 on the sales team, and that includes success, an SDR, and someone who is, kind of calling on bigger clients. And by the end of 2015, they had 35. Because in 2014, they tested, they got revenue, they kind of got beyond the POC, and then they said, okay, we've got the recipe down, we can scale. But at every step of the way, the CEO in this case, who's a multi-time pro, just kind of said, all right, we're getting to this next level, and then we're holding off, we're going to see the way it goes. And so that kind of stepping and monitoring and looking closely at the metrics becomes important. And also having the courage to prune the sales reps who aren't working, and to question whether it's a question of a sales rep or whether it's a product issue. And that's why doing the steps, I think, becomes really important.
Yeah, I think there's particularly in the early stages, you see a lot of the friction between, is it we have people that can't sell, or is there a product?
Yeah.
Right. So, how do you figure it out? Is it just figuring out doing that testing? I mean, what did the company you're talking about? I mean, who was selling? Was it the small team? Was it the CEO? Was it some combination?
It was a combination, and in this case, the CEO was monitoring everything, and he had a playbook that he's used in past companies. He had to adjust it because he had not started to run a SaaS company before. He had done only large enterprise sales, and this is enterprise SaaS. So there, in terms of learning about SDRs and BDRs and how to think about the kind of the right way to market to kind of generate a funnel, that was all from a lead perspective and lead gen perspective was different than he had done in the past. So some of the testing was around that, but most of it was really trying to get this repeatable recipe where they could go in with a script and turn it into something where there'd be a sale of a reasonable amount to know they could justify a sales head.
Mia, you have anything to?
Yeah, I think another part of that that's so important is just that everyone in the organization is telling the same story. So I think the CEO telling the same story as your head of sales, telling the same story as your newest inside sales rep is really critical. And a lot of times I think that the sales leaders who have brought the company from 0 to 10 million aren't necessarily the right sales leader to really scale a sales force and take it to the next inflection point. And so just kind of as a founder, as a head of sales, being thoughtful about what your skill set is and what kind of expertise you really need to bring into the organization.
Hey, Michael, have you seen, just maybe in your portfolio or other companies you interacted with, a lot of turnover, a lot of churn in, say, VPs of sales?
No, I wouldn't say a lot, but echoing, what Mia was saying, there's always a point in time where you have the heart-to-heart, with the founding team, and is this the time where we're going to turn that title over? And sometimes they stay on board, sometimes they don't. But it is something that happens eventually. I think very rarely do you see a kind of seed stage VP sales, if there is one at the seed or an A, go all the way through IPO or a kind of late stage, acquisition. I do want to go back to the kind of customer success piece. I think that informs a lot in the organization, and that you have to get that done early and always solicit feedback from the customer.
There's one thing, is it on now? Yeah. So one of the things that has changed is kind of this merging role, or maybe the kind of the nebulousness between the head of marketing and the head of sales. Particularly for SaaS businesses where there's this kind of lead gen or content driven marketing strategy, and the partnership and the relationship with the person driving sales, particularly if you start with a sales exec first and a sales team, and they've figured out their own process, and then someone with a more marketing and lead gen approach, marketing lead gen driven approach comes in either with Marketo or Eloqua or something like that to help drive it. We've seen some friction, and I think it's healthy, and it's back to the sales guys don't want to give up the processes that they've put in place in order to generate it. The marketing guys want to make sure that it's being nurtured in a way that particularly if a lot of our companies have products that can span from very small to very large, which is something that's really different in this generation of companies than it was 20 years ago. And in doing that, you want a self-service capability that's going to nurture the funnel itself, and then hopefully pop things up deeper in to allow the sales team to pick it off. That's nirvana. And so that kind of healthy tension early going between the marketing and sales is really interesting as they start to merge a bit.
It's kind of interesting. Maybe you could speak to this with the whole marketing and sales friction, because it seems that there's this big challenge where companies want to have this inbound approach. They want to maybe minimize sales and leverage content marketing. I mean, what are you seeing as maybe successful models with that, or how it might integrate with what sales is trying to do?
Yeah, I think having the whole go-to-market strategy kind of working together is important. So everything from marketing to sales, and then customer success as well, and understanding who's responsible for renewal and who's responsible for upsell, because oftentimes the person that's the right person to prevent churn isn't the type of personality that's going to be pushing for upsell and cross-sell.
Yeah, like hunters trying to keep customers when they should be getting new business.
Exactly.
That's really important.
So for our organizations, we've seen a lot of just cross kind of collaboration among the head of marketing working closely with the head of sales to have a unified vision and making sure that there are clear handoff points from marketing to sales.
Has your portfolio companies, ones that you're on board of or what have you, have any of them really succeeded with inbound and content marketing to a huge extent?
A number of them have, and you can do it in a couple of fun different ways. Two come to mind. One is Rocket Trip. It's an enterprise travel solution here in the city.
Dan, that's a pretty cool company.
Yeah, it's a great company. It's a fun company, and what they do is they help enterprise or anybody in any business save money while they're traveling. And so there's a lot of cool, fun content marketing that can come out of that. Fun travel experiences. You can save X amount on any given trip. And I think you really need to get creative, and that's where the kind of sales and marketing come together. Really get creative as to what your mission is, and again, make sure that everyone is kind of singing the same tune as they go to market and talk to customers.
Right. Yeah. Basically, I think we can all agree, have one message and be consistent using it. I see a lot of companies with talking one thing with one company and then totally another thing somewhere else. I want to dive into metrics, right? Because I always say at the end of the day, we've got to evaluate what companies are doing with actual numbers. So what do you find that's important for you in terms of a leading indicator, trailing indicator, or just that gives you the health of the companies that you're managing in your portfolio? I'll let anyone kick off.
Yeah, and that was really good points about having like a person to do the renewals. That's exactly what I look for. my companies, again, are a little bit bigger, so you guys are kind of seeing them, building them much earlier on. What I'm seeing is, when I go in there, do they have the apparatus to be able to move clients along like an assembly line, and do they have that person to do renewals? And do they have that person to do customer kind of success? And I try and keep them really, one of the things that a company has to adjust when they get to a certain size is keeping those people away from each other, because they become client advocates and they start kind of working against the interest of the company. So again, do they have, kind of all the apparatus that's required to move them profitably?
Yeah, from a metrics perspective, there are a ton that we go through in every single process. One question that I like to ask first is what's been the sales rep turnover over the last year? How much of that is voluntary versus involuntary? We have metrics for that, and from there we kind of dive into what's been going on inside of the sales org. The key ones, not going to be a surprise to anyone: bookings, churn, and upsell, and then understanding all of those things on both a dollar basis and a logo basis, because those numbers can be distorted fairly easily. But unfortunately, don't have a magic bullet in terms of metrics for you.
Yeah, I agree. It's a combination. You look at some of our companies, and I saw probably the best example of my company is metrics driven. I saw someone from Better Cloud in here. Raise your hand, Better Cloud.
Better Cloud representing.
There you go. So I think Better Cloud has always managed itself to metrics, and it's really fantastic in terms of how orderly it's become within that company. It's been a great example for the rest of our portfolio. What we look for, kind of writ large, in addition to LTV and CAC and the magic number, which becomes important in terms of the effectiveness of marketing spend in the prior period versus the new ACV in the current period, that becomes an interesting thing. The churn, I think Michael talked about logo churn versus dollar churn, and that speaks to Adam's concern about rising prices. Firing low-hanging customers who are costing you more, I think, becomes important. So in understanding kind of the cost, the operating cost of a customer, not just the acquisition cost. Mm-hmm. All these things kind of come into play. And I think in a metrics-driven organization, particularly these SaaS businesses that are largely what we're funding, it becomes really, really critical, because when you put them all together to customer renewals, you can have a customer health index which can help pinpoint you toward the customers that need more help. And so as opposed to your customer renewal team and kind of perhaps going in and shooting in the dark a bit, you can put more science toward it. That doesn't mean you spam them, but you can direct who your reps internally are spending their time with, as opposed to ones who they shouldn't be spending time with.
One thing I'd add, you hear a lot from kind of seed and Series A founders that it's too early for metrics. We shouldn't be looking at this. We have X many customers and revenue is this. It's really never too early to start. Build your dashboard. The numbers may not make sense, but build it, because as soon as you feel like it's time, it'll be too late. Going back to the rocket ship example, this is something Dan has been fantastic at. He has multiple sheets in a spreadsheet with all the KPIs, and we've done it for a long time, and you constantly iterate, and you can see things that may or may not be in a pitch deck, but they'll inform a different part of the business. We look at rewards and trips and dollar per trip. Things that you wouldn't necessarily hit the financial side in the deck, but you can constantly be making business decisions over.
Yeah, that's a great point. I mean, I think that erring on the side of just tracking as much information as you can without becoming cumbersome for your operations is really important. We're never going to complain about getting too much data. It's like Christmas when we get a data pack and there is a ton of sales and marketing information for us to work through. And honestly, we feel like if the company is being transparent and tracking all of that data, then any slight weakness we can improve, we can fix it. And I think just to add to some of the other metrics that everyone mentioned, competitive win rate is really important, especially if you are operating in a market where there's one or two other really close competitors. And understanding why you're winning is just as important as understanding why you're losing.
Yeah, it's funny because with a lot of founders I speak to, I ask them, so why do you win on a consistent basis? I usually get like blank stares. I mean, that to me looks like that to me is like a red flag.
You're giving it away.
Yeah, they're giving it away.
Price is not sustainable, right?
Are there any red flags that give you pause, saying, okay, I don't know if we can invest in you, or even afterwards, the health of your portfolio companies?
Yeah, definitely. I mean, going back to B2B sales, I always go into a company, I want to make sure sales reps are making money. The idea is to get the product out there, SaaS is great, but if there has to be a process for selling them and improving the numbers. So I'm always, again, very concerned when I go in there that the sales reps are being properly compensated and they've got a structure figured out to reward the A players and reward the B, and that they're making a living.
There are a lot of different types of red flags that come up. People get creative.
Creative accounting. I think there are some big companies that got in trouble, a decade ago for that. But
there are a handful. One that comes to mind is how you set up the contracts. We looked at a company at one point, and caught that there was a kind of 90-day out. But then, every single customer had converted that was currently in the list, and we kind of went back, and what was happening is if the customer wasn't converting, they were never a customer, so it wasn't churn, but they had gone through the sale and kind of onboard. And depending on which VC you ask, they may or may not count that as churn. We're a little bit meaner, perhaps, and we did. So that's one that comes to mind, but they're a big variety, for sure.
Yeah. And so, there's what I'd say is a magenta flag and then a red flag. Let's start with a red flag. When you look at how the sales team is comped, that can, quite frankly, you can gin up a bunch of stuff if you're comped on bookings, and that's still done today. And so there's, that's something where you kind of look at it and you look at this 90-day out in terms of the contract as part of it. When you combine that with someone who's comped on bookings, that's a dangerous cocktail. And the magenta flag is really how the LTV to CAC calculation is done, and whether and there's been a lot in the kind of blogosphere about this more recently. When the temptation is just to do it, and the simple way of doing it is kind of gross LTV. And if you really want to do it, and you want to get a gross margin, and very few companies that we look at actually do that, because it's not really looking at kind of the true long-term value for the company.
Yeah, because they can't predict it going forward too far. It's a big problem.
They can.
In my category.
No, they can predict. I mean, there's a calculation for predicting it, but if you're not addressing the actual costs of that revenue, it's not the long-term value of the company. It's just looking at the gross level.
Yeah, long-term value, cost of client acquisition. I mean, what are things that are coming up in your world that basically, because you see a lot more metrics, and you're diving in because there's a lot more there to look at.
Right.
So what are you seeing that's popping out at you?
Yeah, so a big thing is where the customer success cost is being bucketed. So for us, we're always looking at it in terms of cost of sales, because in order to maintain that customer, you have to provide the customer success function. But for most of the SaaS companies that we see, they
cut it off,
bragging about their 90% margins, which only include their hosting expenses. And so it's not really a realistic reflection of the ongoing cost to maintain a customer, as you mentioned.
What are they doing with the marketing cost for free customers for the free trials?
Oh,
that's also another
go
way
below the line. Yeah, exactly. And they're moving it to be more favorable, and it never even gets captured in CAC or anything. And so I think just we look at things on a fully burdened basis. We can understand, that you're going to scale and you're going to improve efficiency, but we want to look at it in the most true to form way.
The one other thing I'd add there is onboarding costs. That's one that's overlooked frequently. Onboarding, particularly with the larger enterprise software packages, is a true cost of goods sold, and should absolutely be included there as well. And
is also be charged for. So there's a reluctance, particularly for early stage companies, to actually charge for the onboarding, because they don't want that. Well, it's been so hard fought to win the deal in the first place. I don't want to go back and say you've got to pay me for my time for onboarding. Yeah. What we found is that maybe with a gentle push toward the founders, they find that customers, once they've gotten budget approval, they're okay asking for a little bit more in order to pay for it, in which case it's a wash, at least.
But are you seeing that happening with the CEOs, or are you seeing that happening with the sales people?
Well, we push the CEO who pushes the salespeople, and sometimes it's one and the same.
Yeah, and I think getting the pricing right is a big thing as well. So figuring out whether you're just going to bucket implementation costs and ongoing professional services expenses, and just how sensitive the customer is to that. And also a red flag, I think, is looking at the discounts that your sales
discounts
reps
can
are
be
giving.
A real challenge.
Yes, yeah.
I mean, I've seen a lot of, particularly in early stage, you're just basically giving away the product, but you look at it as a booking, and that kind of you reflect it out to what it may be downstream, but it's not incorporated, kind of an early
You've been working
stream.
with a bunch of companies that seem shifty, Mark.
I might be,
Yeah.
it might be some like bad seeds out there.
I don't think it's. I mean, maybe I'm just see the milk of human kindness too greatly in our founders, but I think that there's just some aggressiveness around it without understanding what the implications are. So as opposed to giving it all for free and booking it anyway, what we do see are the temptation to have multi-year bookings early for subscription business in order to bring cash in, which makes sense. But the problem is the discount that comes with that, and then the fact that you may be raising prices, as most companies do, over the ensuing years. And if you set the pattern, it's very hard to get away from it.
Yeah, I find that trying to do low price and then going back to the well to get the higher price invariably gets you stuck.
One thing that I'll add for founders, we're going through a process now, and it's happened before. He has 3 or 4 different VCs currently on his board, and he's getting 3 or 4 different answers as to how to calculate LTV and CAC, which is mind-boggling
no
to
way.
me.
I'm not on this board.
Maybe. And so, it's very rarely coming from a place of, something being dishonest. The best way to deal with it is to, pick a formula. Hopefully it's the one that's most frequently blogged about and the one we just talked about. And then just explain through it and be open in the presentation. And if you make an honest mistake in a presentation, that's totally fine. We'll walk you through it, and you're kind of expected to at the earlier stage anyway.
So I want to just open it up to anyone who has questions in the audience, around your situation, sales, so on. Feel free to ask away. I want this to be iterative. I want us to get this opportunity to learn from each other. So if anyone has any questions, feel free to raise your hand. Otherwise, I'm going to keep asking away. Oh, well, there's a gentleman over here.
You said a couple times about how the salespeople get involved.
Yeah.
There's some called salespeople. Some are red flags, some aren't. Some are good things. But you never really kind of. And you give a couple details around that. Can you build up more on that? Because as a salesperson, you have to kind of yourself.
So the question is maybe a little bit more specifics around sales compensation, how that plays out with startups.
Yeah, well, a lot of it depends on the price of the product and how long-term the contract is to kind of figure out, and how much, if they're in a mature market, how much the competitors are charging. So, I can't say that there's a rule of thumb, but I can say it depends again on the product and on the contracts. I like larger contracts. So a lot of the companies we have are multi-million-dollar contracts going forward, and I really want, and even in the smaller companies where they just don't have the margin that they should, and again, I think of sales commissions as profit distribution, so I want to make sure that those guys are getting as much of the compensation as they can and getting as much skin in the game. Also, it depends on the frequency of their compensation and what the plan is. So are they getting paid for that contract basically once the check is received? Or are they getting it over kind of a lifetime? Is it a recurring type of revenue? Is it a residual? But it's a really important metric. I think it's one of the most crucial because it's one of the best ways I can evaluate the culture of a company, how much they value their people, how they value their clients. I think a lot of companies don't really value their clients as much as I'd like to see. It's a very strong asset, and again, that goes part of the compensation. If you're bringing on the right people, and if you're bringing on the right people for renewals, making sure they're getting compensated properly for that also.
Is there any kind of non-standard sales compensation that you're seeing out there, or is it the standard base commission and SDR levels get lower levels, AEs, and so on?
We're seeing, kind of in general, kind of a 50-50 base plus, incentive, for commissions. I think I agree with Adam. In terms of the timing of it, whether there's, and the stage of the company, quite frankly, because in earlier stages you might actually provide some compensation on bookings with the ability, essentially, doing it, paying by quarter,
Sure.
in case things don't materialize. So there can be a catch up, but in general, I think there's a set of formulas, and some are more or less distasteful to the early team. But I don't think that we tend to be draconian as investors. We just want to make sure that it's kind of standard.
Okay.
I'm sorry, it's not super specific, but it really depends upon the company and the situation.
Yeah. And maybe extending upon it, are there any models or something that you've kind of seen with some of the companies you're working with that has really worked, that's been kind of interesting or different, something that they've taken on themselves, and you said, wow, it's really interesting. It's not just hire a bunch of reps and go out to the streets.
You're talking in terms of incentive, or
Just in general, you know, whether it might be process, maybe leveraging technologies, maybe an interesting way of hiring.
Yeah, in a lot of our companies, we've seen a kind of promote from within approach. So giving a clear career path to the inside sales reps, the SDRs, the MDRs, to see how they can eventually become a field rep and be quota bearing and have more of a career trajectory, I think has been a really good thing for culture. One of our portfolio companies is Conductor. They're an SEO measurement and analytics solution that's based here in New York. And something that the executive team implemented was dressing in suits on the last day of every month, so that all of the sales force kind of felt like the end of the month was as important as the end of the quarter. And it helped kind of spread out the sales throughout the quarter, so that instead of just seeing 2 months of slow performance and then one last month in the quarter of really high, kind of try to get as much of the quota in as possible, they kind of spread it out more, and it was helpful.
So this has nothing to do with the sales metrics or the incentive, but I'll pick on Better Cloud. Dave Politis, the founder and CEO of Better Cloud, a couple of weeks, was it 2 weeks ago, he blogged about this, maybe 3 weeks ago. Internally, culture is so important to this company, and I think it kind of exceeds the walls and it permeates their customers. They have this very rich community, and that's probably where they've done the most special job of doing it. Reflecting it internally and as a company scales is super hard. And so what Dave did was he created an operating manual, his own operating manual, and had everyone in the company do the same thing, and they posted it. He blogged about this a few weeks ago, and I'm in the process of building my own operating manual as a result of it. But it really speaks to kind of this openness of a culture, so people understand, Mark, you shouldn't talk to Mark first thing in the morning until he's had 2 cups of coffee, because he'll be grouchy.
5
Yeah.
cups. I
Or
need
it
5.
could be, Mark prefers communicating via Slack, and he'll never return an email, particularly if you send it to
Not
his
true.
work address. But I think that what we've seen are companies, as they're growing, kind of maintaining that culture and doing things which are authentic to build culture, as opposed to just kind of taking everyone out and playing laser tag or paintball, becomes really, really critical, harder to do, and I think the community at large really recognizes it.
Yeah.
Michael, I want to interrupt you because you have this amazing depth, because you've been looking at the whole sales technology stack, right? So are there any companies really leveraging that to the hilt?
In terms of the full kind of
Sales stack and automation, getting and seeing like real positive results.
Yeah. Before I get there, I did want to make the one point. Even though you interrupted me, I'm gonna go back. Shocked we got through a full panel with no one saying your customers are your best sales guys. If I look across the portfolio, the companies that very consistently have their own customers, doing case studies for them, or tweeting about them, or selling for them at conferences, that helps and is a big deal. So a good product does that, but focusing on the customers and your good ones, your successful ones, can lead to good results.
Tell the stories.
Yeah.
Get the stories out there.
Totally. We just kind of ripped and replaced the entire stack at a company called Bellhops. And I went in there and kind of sat in on customer calls and looked at all the different systems. And we had built, as a company scales, you end up building all these internal systems where you're putting data in 5 different places and none of them end up talking to each other. And we got Intercom up and running, Slack up and running, Gainsight, all the way through, and everyone is seeing the same dashboard every single day, and they actually have TVs all throughout the office with the KPIs that this stuff is feeding through. And again, I'm going to be known as the customer service guy as I walk out of here. But having all of that data and all of the conversations in there, going back to the sales reps at any given time, is so important and is huge for any business.
No, I like the fact that you have the stories and you build a collection of these stories so that reps have them out when they're actually having these conversations with prospects and leveraging that. And we had a really great conversation last December up in Boston with Emmanuel Scala of Influitive. So it's a company that really does an amazing job just around leveraging referrals and references and case studies to amp up their sales. So I'd recommend if you want to look at a company that's really just super great at that, check out Influitive. Adam, what are you saying? Is any anything interesting or innovative?
I think there's a lot of innovative companies. I mean, just in terms of innovation, I had to beg my way into a company, Slack, that I was with a friend who has a company, and I think that they're really rethinking. You know, one of the problems when you have large companies is it's very difficult to cross-sell to them. And large companies, I don't know if you guys see it, but they always, you know, companies, particularly tech companies that have a lot of SaaS, they always underestimate the amount of human intervention required in cross-selling once they have some other products in there. So I like Slack on the enterprise now. So I think that they're really kind of innovating how to sell into an enterprise, how to use pushes, how to use notifications is, I think, really innovative. I think it's going to change the entire relationship that, you know, people have with, you know, their company.
Questions? Here. Let me walk up.
Thank you. What are you seeing with the companies you're working with, the inflection point where they're going from taking in inbound leads and having somebody do a webinar for a customer to where they actually have to move and start bringing on enterprise level people to go in, develop relationships, and move product?
Kind of consistent ACV well in excess of 10 grand. You just can't, you know, below that you cannot justify a body. It's even harder, you know, to kind of justify a body doing a lot of webinars if you don't have a big enough audience with the webinars. So that's kind of just a very, very base rule of thumb.
I'm not a big fan of webinars. You know, I think for a larger sale that they're really inefficient because I think for a larger sale you don't really get the intimacy that's needed for a larger sale.
That's exactly what I'm asking the question. What are these companies figuring out? I got the inbound lead, I have the girl doing the webinar and they're talking, but when do I realize I got to get somebody in there that can actually start finding out who the multiple decision makers are, what their problems are, versus just pitching something and maybe asking a few questions?
I mean, when you start actually, you know, requiring bodies, I mean, it's a huge investment, right? So, I mean, to your point, I mean, you know, if it's anything under 10,000 ACV or average contract value size, it becomes hard to justify just more people and direct sales reps. Yeah, it's very much an SMB type sale.
Yeah, I would add, you'll know when your conversions kind of fall off a cliff and you realize that you need to have that specific attention. But I would also just think about it purely from an LTV to CAC standpoint. Can you afford to hire this person to go do that? And does the business still make sense? You know, one of those variables we'll have to give there.
Thank you.
Right up front. See, up front.
So Michael, this is directed towards you. Relative to your comment about investing in CSMs early, especially whenever you're figuring out you know, kind of like what makes the customer happy and what does the customer want, right? Why invest so much on the CSM side relative to, you know, you'd hire a CSM before another salesperson? Because, you know, I always look at, you know, can you outrun, you know, you can't outrun churn, right? If customers are really terrible, but in some aspect, you know, isn't it better to have the problem of too many customers and figuring out how to make them happy or how to retain them, right? Rather than the opposite of, you know, kind of invest in, you know, these kind of strategies about how to make customers happy or invest in these long-term programs to help people. So, you know, I just take I'm on the other side where I'm like, okay, I got to hire another sales guy and try to help us outrun, you know, not churn, but also just kind of fill the funnel and drop people as far down the stage. And then I can figure out, you know, whenever we get to that point, especially if I'm selling 2, 3, 4-year contracts, that, you know, how do I keep those people invested in long-term and upsell?
Yep. Yeah, so a couple of things. I think generally speaking, you know, the founder is always going to be the first sales rep. So you have hopefully a kind of heavy hitting sales rep that's going to be there. So you're not necessarily hiring the CSR first. They're still kind of coming second. You know, and it really depends on the business. It sounds like you have a very low churn business, in which case that makes sense. I think if you see that early on and people are super sticky, you know, hey, maybe delay that a little bit. You know, I don't know if they're month-to-month contracts or annual, but all of these things kind of come into play there. You know, I think all things being equal, and have looked at, you know, hundreds of these companies, they just always are hired too late. And they don't know why they're churning when they are, and it, for some reason, always happens right before a fundraise. You know, and those are the types of things that you can try to avoid hiring them early. And they're also generally cheaper, a lot cheaper than a sales guy. So you can get them in, and sometimes they start selling a little bit. So that's kind of the point of view.
Yeah, I would take another point of view on that, which is that there's this great CEB study called Blinded by Delight, and it says how you can, perform on your customers' expectations, and they'll be no more loyal than if you just deliver on their expectations. So, there's a balance, I think, in spending to make them happy, but I think to the extent that you can provide any support they need within your product, the biggest thing for customers is just their ease of getting an answer and the quickness of being able to do it. So if you can have, in-app chat or things like that, I think that's a really cheap way to deliver just the baseline kind of expectation for them.
Yeah.
I would argue that the approach you're taking is kind of old school, and the idea of just pushing the rock away from you because you have a 2 or 3 year contract, and if you're in a highly competitive market, you can't afford to do that. The best companies are thinking about how they're going to scale from the start, and customer success is part of that. And if your competitors figured out that you're not investing the time in that, and you're kind of building the front part of it, you're sitting duck. And that's something, so again, I have no idea what business you're in, but I know for our companies, they're assuming that highly competitive businesses, there's always an alternative, and they've got to figure a way to love their customers without overspending on it.
And just to that point,
Yeah, just beyond the metrics, I think the other key piece, particularly at the early stage, is informing the product. So as important as it is to upsell and prevent churn, it's how can we make this better and actually help the sales guys later on because the product is so much better.
Well, I think that's like where, if I could,
Yep.
I think that's where we invest a little bit more, right? Keep the CSM team a little bit leaner, right? But build really quality products that help keep people sticky, right? And you guys talked about, how sticky is that? Can you start to invest and get other people from different business units to start utilizing the platform, right? And then churn always becomes, it's a non-starter. We like to make it a non-event, right? Renewals are non-events in kind of the business. And we don't like to talk about like, this is your renewal day, and some people like really focus on those things. But if you make the product sticky enough and invest other people from different business units, that it almost becomes this natural organic growth inside of the business. So
you basically spread out customer success among a bunch of different people is the way that you're doing it, as opposed to concentrating it.
Even a salesperson can act as, I think, maybe as a CSR, and really great, PMs can help, kind of mitigate some of the churn as well, right?
Yep.
Thank you.
we're going to take one last question because we are running out of time. So please.
Okay, so holding all of the other variables equal, will you guys place a higher weight depending on what department the contract is sold into? For instance, a marketing expense versus an IT expense versus other expenses that might be more mission critical, or is it going to be dependent on the company and really just that metric driven versus, how does this contract get bucketed into which department?
So if I understand the question correctly, do you see the upside or differences of valuation of companies based upon where it's selling or where the money comes out of from the company? Whether it's maybe the IT's budget or line of business budget. I mean, does that actually play into anything you look at?
I think it's a cruciality question, and particularly as you think about the ebb and flow of markets, something which the old venture capital line is we want to invest in painkillers, not vitamins. And so while you can't necessarily look at the department and say that's a painkiller or a vitamin, that's this quality of revenue. We want to back things which are essential, and that if you stop, like if you basically stop the service tomorrow, the customer is going to scream, can't run their business without it, because then you can charge them more for it the next day.
All right. I always ask this one last question of everyone. I want to, each of you, we'll start with Mia first. A book, it doesn't even have to be a book, but just something that you've read recently or seen recently that's been really inspiring that might be relevant for this group.
Well, other than my marathon training guide.
Well, the marathon training guide is awesome. I'll ask you about that later.
I recently watched a TED Talk by Adam Grant, who's the Wharton professor, and it was on the thought process of originals. And it was interesting because he was saying how there's this perfect balance between precrastination, which is attacking a problem too early after learning about it, and procrastination, where you don't necessarily have enough time to really think through all of the possible outcome. So there's a perfect kind of balance in the middle where you think about a challenge and then you have enough time to really kind of mull over the ideas and come up with your most creative outcomes. So I thought that was pretty interesting. It's worth watching.
Yeah, love Adam Grant's stuff. Yeah, really, really great.
So, not necessarily a great business lesson, but I'm in the middle of reading a book called Sapiens. And if you really want to blow your mind, particularly if you've got a particular view on the evolution of humankind, this is a great book to read.
Sapiens, all right.
Yeah.
Outside the scoop, I like it.
Non-business reading.
Mine is a little bit more boring. I've finally gone through and watched every SaaStr video. You end up meeting with people and not watching any of the content. And it was some actually really good content there, particularly around the Slack platform and the function that's going to play, not only in the sales org, but all the way across the business. The other one that I would highly recommend is Thomas Tunga's chat on kind of early stage SaaS, and he did a really good job with some of the metrics and breaking down what it is that we're looking for at the early stage.
Yeah, no, I love both of those. Jason Lumpkin is, he's written a lot about early stage sales, setting up teams, so I definitely recommend that. And Tom is a really great view on metrics. There's also another gentleman up in Boston, I think he actually lives in Boston, DC, David Scott, who has a lot of really great writings. And
Who corrected himself. He actually, there's a lot of talk that David has kind of early on LTV to CAC and then kind of a more focused version of it.
Right.
Yeah, yeah, sure. I don't read any of that stuff. I don't read David. I definitely don't read Tom. I like them, but we're on a different side. He's very analytical, but it's also at a certain point for B2B sales almost bull. It honestly is. It's bull. In fact, I just declined doing a deal with him because I thought so much. But because at the end of the day, he's looking at something, particularly when it comes to sales, without kind of that deep, intimate type of understanding. So he's looking at something kind of very mathematically, as opposed to being there. And it's a completely
in the
different
moment sales. You mean?
Yeah, well, not even in the moment, but it's one thing. I've been on both sides of the equation. I've looked at something kind of as a venture capital and analytically, and that's one, perspective. But the other perspective is actually doing something and actually getting to a revenue point. So I don't read any of the venture capital blogs. I think they're, from my perspective, mythological. You can't really. So.
Good read though.
Yeah, listen. It's true. It's mythological, and just because they had some success, it doesn't really project forward in any way. And I think the behavior, they don't really understand how much behavior is shifted, over the course of the year, because over the course of the last few years, because they're looking at something historically and they're not feet on the ground, so they don't know what goes forward. So I don't read any of that stuff. I read everything though. I read Fed reports, I read all the boring stuff.
Yeah, you read all the boring stuff. How about something that which is really cool, that would be practical for us?
Well, I'll tell you, one of my favorite books that I was just discussing with David is Ron Chernow, Alexander Hamilton. It's amazing how much a person who's determined, how productive they can be within seconds and within minutes. It was a lifetime, and now Hamilton, and he did it. Yeah. How absolutely productive a person can be in a very short, compressed, day and a month and a week. How much you can really get done. So.
Has anyone seen Hamilton? Just out of curiosity.
Yeah.
The musical, I've not.
I know the family really well.
That's awesome.
Is it? That's Lin-Manuel. Good guy.
I just want to give a round of applause to our awesome panel.